Inflation has already bankrupted the bottom 3 quintiles. These people are very much suffering. They're finding it difficult to heat their house and to put shelter over their heads and cool their house and to drive and to afford insurance. So if the Fed and the Treasury join hands now and decide to monetize some kind of form of helicopter money like they did last time, where the Treasury just borrows trillions of dollars and the Fed prints it all for the banks to supply, you could get an enormous spike in long-term interest rates. And if you have an enormous spike in long-term interest rates because they have the lack of confidence, by the way, the Fed does not control long-term interest rates. They control mostly the money market. So the Fed fund, overnight interbank lending rate, and thus the money market rate. If we get a spike in long-term interest rates because of inflation and insolvency fears, then we could have a real problem in the stock market and in the real estate market that is not easily fixed by all this liquidity. It just causes people to panic. I just want to add that the last 2 recessions that we had, the deficit increased by 300%. You can have a U.S. deficit of $6 trillion the next time we have a recession, because these automatic stabilizers just kick in. And people, they get the food stamps, they get the unemployment insurance. There's no act of Congress. It just kicks in. Revenue dries up and expenditures surge. $6 trillion. At what price is that debt going to be purchased, and who's going to buy it? And what's the cost to inflation? These are the things that I think about. Hurricanes absorb a lot of energy from the ocean with heat and dissipate that. And if forces in the world, they tend to look for stabilization. So the good news is that if real estate prices collapse and if the stock market returns to some semblance of normalcy, you might not have such a bifurcation in society any longer where we have the very wealthy and then you have the poor. I mean, you'll actually invigorate the middle class. That's one of the silver linings. The Fed is trapped. They have this loosening bias, and they were supposed to cut rates, I think, 4 or 5 times in 2025. That's not going to happen. The Fed can't cut rates. They want to cut rates. The primary reason why they want to cut rates, in my opinion, is the Treasury can't afford to pay $1 trillion of interest on the national debt. Yellen floated all of our debt at the very short end of the yield curve. So she has to roll over this debt constantly. Well, the money market rate competes with the Fed funds rate, and if the Fed can get the money market rate down to, say, 2 or 3%, that would be wonderful. Cut a lot of interest expense off. But they can't do it because inflation is almost 4 years above their 2% target, and it's moving further away from that target. We had a PPI data today. It was 3.5% year over year. Core rate of inflation is 3.3%. Those are much higher than they were in the previous month. So it's going away from the Fed. There's no way that they can lower rates right now, so they're stuck. Although I think they would really, really want to, just to help out Janet Yellen and the interest expense on the national debt, which is $36 trillion today. There was somebody in power wrote an article about how we could revalue gold. I don't know if Trump is talking about this or if Bessent is talking about this, but I think the Treasury has 261 million ounces of gold that are $42 an ounce. So if the Treasury, they can all play all these accounting gimmicks and tricks. Listen, they have about $750 billion worth of gold at the Treasury. I don't care if they value it at $42 or $3,000 an ounce. Doesn't matter to me. The market value, the gold hasn't changed. The position of the Treasury's assets has not changed. Here's where it gets a little funky though. Apparently, if they revalue gold to a market price of $3,000 an ounce, that somehow enables the Fed to repo that gold. In other words, print money out of nothing and hand it to the Treasury. And then the Treasury general account would have $750 billion newly created dollars, which they then could just buy down the debt, which would be a flood of us. It would be like a $750 billion overnight QE program. Now, that doesn't really do a huge dent in the national debt, and it really doesn't. It only brings the deficit down a little bit. It's not such a big deal. And then I heard there was a rumor that they were going to revalue the gold to like $142,000 an ounce and then pay off the whole thing. Just get rid of the whole thing. That's Zimbabwe kind of talk. That's just ridiculous. There's no magic here. They can play accounting tricks if they want to, but all the government can really do is inflate away the problem, be it by revaluing gold or not. Now, I would have no problem if the Treasury sold its gold on the open market. I would not care at all. But then the Treasury would reap the reward of selling that gold and then have no more gold to back its currency, which would be a whole other problem. So these are just games and they will not amount to anything. If you ran up in a tremendous amount of credit card debt that you can't afford to pay back, there's no innocuous solution here. You could print it away if you had an Al Capone's printing press in your basement. You could try that. But you're going to have to default on this debt, and it's going to bring your living standards down. You're living high in the hog. You're going taking vacations. You're buying cards, racking up all this debt, and then your living standards are going to crash because you're going to try to pay this debt back. You could also default on the debt, and now it's the bank's problem. $36 trillion. I mean, if you owe $100 to the bank and you default, it's your problem. If you owe $36 trillion to people, it's somebody else's problem. It's the ownership of the debt. It's the pension plans, and it's the shadow banking system, and it's the regular banking system. It's foreigners that have the problem. It's the primary dealers that have the problem. So there is no easy way out of this. It's either going to be done the correct way, the real way, which is an explicit default. Hey, we can't pay this debt off. We didn't even talk about unfunded obligations. There's hundreds of trillions. So you either can explicitly default, hey, we cannot pay your Social Security, Medicare, and Medicaid. We're going to default on that. Or you could monetize it away by just printing $1 trillion, minting $1 trillion coin or printing trillions of dollars. Either one of those two things or some combination of those things is going to happen, and there is pain, a lot of pain involved in either way. Because don't forget, someone's debt is someone else's asset. So someone's going to lose, maybe both. I look forward to the day where the stock market craters and I'm sitting there with all this cash and liquidity. I can jump in and buy quality U.S. companies with a big, fat, solid dividend and with a level of safety that we haven't enjoyed in decades. And wouldn't that be nice? But right now, that's not the case. In fact, if you look at a lot of the metrics that have the overvaluation of equities, the average annual return over 10 years is like minus 0.3%. That doesn't mean you can't get 5% in 25 and 2% in 26 and then minus 30% in 27. It's going to be highly stochastic, the years returns. But the average, if you average them all out, is a negative sign based on the valuations of today's market. So you mentioned my portfolio right now. I have a lot of minimum volatility exposure. We're about 20% net long. We have gold, we have inflation hedges, and we're comfortable with that. We have a lot of short-term U.S. treasuries too, just spinning off over 4% income into the portfolio. What I want to do is understand that the amount of upside in the market is very limited right now. And the potential for a significant and salient downside correction is very, very high. And I'll use my timing model, which tells me right now I do not need protection on the downside. I don't have any. But when I do see my model signal that we're heading for what I call sector one, which is deflation and recession, I'll go into higher levels of cash. I will hold treasuries, I will be long the US dollar, and I will short the market. If the market crashes and I get the timing somewhat correct, I should be able to make money for my clients because those four asset classes will either not go down or appreciate in value, and then be able to be in a position to pick up the pieces because if you bought the market in March of 2009, what a wonderful thing you could have done for your clients. If you could have bought treasuries in 1981, 30-year treasuries yielding double digits. What a great move. So this is what bothers me about my industry, which I've been involved in for 34 years. A lot of people get paid just to be salesmen and women. They say, let me have your money. I'll invest it in the stock market. And, I'll kind of closet index the S&P 500. I'll buy some bonds with that, maybe some overseas stocks. And don't call me, please, when the market crashes, because all I'm going to tell you is, hey, it's time in the market, not timing the market. But if you have a robust model, what you can do is you can say, well, what asset classes do I want to own? And when? Do I want to overweight bonds here or do I want to short bonds? Are we in inflation or are we in deflation? Are we in recession or are we in a boom? And doesn't that make sense? I mean, suppose I said to you that I want to go short the bond market in 1981 because of inflation, because I thought inflation was going to get worse. It would have been a disaster. But what if you could buy bonds and buy equities in 1981? What a great move that would have been. So today you see equities at all-time high valuations, ownership of stocks as a percentage of assets for American families at an all-time record high. Valuations through the roof, as I said. Is that when you want to overweight equities? Or is that when you want to be a little more cautious? So just be a little smart, be a little more of an active manager. Understand when you should short the market because there's a tremendous amount of money to be made on the downside. And it's going to be a beautiful reconciliation of stocks and asset prices because wouldn't it be great if you could afford to buy a house? and not spend, 40%, 50% of her income on mortgage payments or rent payments. That's not normal. That's not right. I wish the best for this country. I pray for this country, love this country. But you can only live in fantasy for so long. And the asset prices in stocks and equities and the corporate bond bubble has gotten to a disastrous, it's become a monstrosity, and it must correct.